What's going on, everybody? Chase Lawson coming back at you with another episode of the Financial Freedom Show, where I make personal finance simple. Thank you for tuning in. I am really excited for today's topic, and I think you'll find it to be interesting at the very least. In fact, this is my favorite episode I've done yet, so I cannot wait to jump in. So let's get started. And if you haven't yet subscribed, please go ahead and do so and hit that notification bell so you're always alerted when new episodes drop. So a lot of people in America are constantly asking whether or not they should buy a house as opposed to continuing to rent. A lot of people feel they will eventually purchase a house, they just aren't sure when. In fact, according to a survey conducted by the Harris Poll of more than 2,000 U.S. adults, 75% of Americans say buying a home is a priority. In addition, it was found that the biggest reason people put it off is due to financial reasons. And despite 75% viewing it as a priority, only 32% intend to do so over the next 5 years. So with that being said, what is the smart move? Is it better to rent, or should you go ahead and buy a house? Well, to give you a sneak preview of my answer, I currently own 2 homes, so my recommendation personally is to buy, but we'll break down the math using one of my homes as an example and show you why that may be the smarter decision, along with giving you ammo to use in making your decision. So I bought my first house back in November of 2017, almost 3 years ago. The sale price was $280,000. If we look at U.S. home sale data using the S&P Case-Shiller U.S. National Home Price Index as our guide, we see that since 1991, U.S. homes have increased an average of 3.63% per year since 1991. This includes the drastic reduction in home prices experienced in the late 2000s due to the subprime mortgage crisis and housing bubble. If we factor that out and look at the data since 2012, we'll see this rises to 5.89% per year. So what exactly does that mean for the value of a home?
Well, let's plug in this data and approximate the future value of my home. So as you can see here, using this future value calculator, I can plug in the purchase price of $280,000 projected over 30 years with no additional deposits, and using those 2 different rates from the Case-Shiller index to forecast what the price would be after 30 years. So with only a 3.63% annual increase, we can see that the future value is $816,000. With a more aggressive 5.89% growth rate, that number almost doubles to $1.56 million. Pretty good money to be made. Well, what if we just invested money in the market instead? As I've shared before, you can realistically expect about a 7% annual return in the market, so that would be a better return than a home. So let's use a present value calculator to determine how much we would need to invest in the market today for it to rise to the same amount in 30 years. So being conservative and using the lower end of the threshold of $816,000 with an annual return of 7%, we can see that we would need $107,195.57 today to invest in the market for it to rise to $816,000 in 30 years. Now, while that is a great return of over $700,000, the great thing about a home is that you don't have to put down that much on a home to get the same final value. Were I to put 20% down on the house, I would be putting down $56,000 or 20% of the $280,000 purchase price, which is almost half as much as I would need to get the same result in the market. And just for fun, if we use the higher end of the threshold with $1.56 million, we can see that we would need over $200,000 today, which is almost as much as the home was purchased for. What if your mortgage payments are more than your rent payments? A lot of people use that as an argument to rent, as they can take that difference and invest it in the market and potentially make more. Well, once again, let's look at the data. Geobankingrates.com did a study in 2018 and found that in only 10 states in the US is it cheaper to rent than it is to own a home. This assumed a 20% down payment on a medium-priced home with a 30-year fixed-rate home loan and factored in property taxes and insurance as well. And for some of these states where renting is cheaper, the difference is marginal, but the question still may be valid. So to answer this, we can calculate it as well to figure out what that difference ultimately is. So if our target is $816,000, or the lower end of the threshold we calculated before, and we start with the same $56,000 initial deposit, which was the 20% down payment, and use a 30-year time horizon with a 7% annual return, we can see that each month we would need to invest $333.24 to end up at the same final value. Based on the geobanking rate study, only Hawaii had a bigger net positive difference than $333 per month if you were to rent as opposed to owning. For me, I went from a 2-bedroom, 2-bathroom, 900-ish square foot apartment that went for $2,300 a month to owning a 2-bedroom, 2.5-bathroom, 1,000-ish square foot house paying $2,013.32 per month for my mortgage. So I actually was able to save close to $300 a month. Plus, when you rent, your rent is always subject to increasing upon renewing your lease, whereas with a fixed rate mortgage, your payment stays stable. So far, we've been talking about a 20% down payment. A lot of people delay buying a home simply because they don't have that much available to put down on a house. And that is a valid concern. But despite the common notion of a 20% down payment, ever since 1934, you haven't been required to put that much down. In fact, many lenders will allow you to put as little as 3% down. That is what I did for my first home purchase. 3% of $280,000 is $8,400. And due to some seller credits, the total I paid up front, which included the down payment as well as other closing costs, was only $8,645.23. Now, if you put down less than 20% on a home, you are responsible for what's known as PMI, or private mortgage insurance. This protects the lender in case you cannot make your payments. For me, this amounted to an extra $260.28 per month, which was included in the $2,000 monthly mortgage amount. Once you get to about 20% equity or ownership in the home, PMI can be removed though, and I was able to remove that within 2 years due to overpaying on my mortgage. However, had I only paid the minimum monthly amount, it would naturally fall off within 10 years. So even if you needed to put less than 20% down, PMI is not forever and can allow you to purchase a home sooner. So let's look at the math once again here. So this time we're putting a lot less down. We still have the same 30-year target price based on conservative estimates, and interest rate and time period is still the same. But now we're starting with less and using more debt as leverage here. So to match the final outcome in the market, you would need to contribute $641.49 per month, which is over $300 more per month than before, which is more than the PMI I was paying. So I'm coming out even more ahead despite paying an extra $260 per month. The fact of the matter is, you will have to pay to live somewhere, but with home ownership, you get to build equity, and whenever you do sell your home, all of the money that went to principal is yours to keep and use elsewhere as you see fit.
Well, what about taxes and closing costs that you have to pay when you sell your home? This is probably the greatest thing about owning a home. First, let's look at the tax implication with your investments. In our scenario we've been using, you had your money invested for 30 years. When you have your money invested for more than a year, you pay less in taxes due to long-term capital gains taxes. This rate will vary and will be either 0%, 15%, or 20%. In our examples we've been using, all scenarios have resulted in at least $500,000 in gains on the market. If you were to sell all of that at once, you would be subject to 20% long-term capital gains taxes on the entirety of the growth. Since income above $441,451 for a single person or above $496,601 for a married couple filing jointly is subject to the highest rate, plus another 3.8% in net investment income tax, which means that your tax bill will be at least $119,000. When it comes to your home, if you sell your principal residence, you can deduct the first $500,000 in profit if you filed married filing jointly and if you lived in the home for at least 2 of the last 5 years. So with our conservative estimates, most of the gains experienced over the 30 years would be subject to no income tax, and at most, $36,000 is subject to income tax, which would be subject to the long-term capital gains tax rate, which, since a lot less is subject to taxes, likely would qualify for a lower tax bracket of either 0% or 15%. So instead of $119,000 or more in taxes, you would only be responsible for either $0 or $5,400, assuming you did not bring in another $400,000 or more in income that year. And all of that money could be used immediately. And in addition, the government has passed legislation allowing you to deduct both PMI payments and interest payments for tax years 2018, 2019, and 2020 so far, which could result in more money being saved each year. Personal loans are not tax deductible, but interest on certain types of loans, including mortgages, are. So for my home in tax year 2018, I could write off a little over $10,000 in interest as well as over $3,000 that I paid in PMI, thus reducing my taxable income by over $13,000 total that year. Plus, property taxes are deductible as well. Another win for home ownership. A final benefit I'll mention about home ownership is that while when you rent, you may be subject to a number of rules and restrictions, including the ability to rent out a room or sublease your place. When you own a home, you have much more control and can essentially do as you wish. This includes being able to make money by renting out a room or the whole house. With my first home, part of how I was able to overpay on the mortgage each month to knock off the PMI within 2 years was due to renting out an extra room through Airbnb. Now that I've bought a second home, I moved into the new home and was able to rent out that first home and now consistently bring in over $400 a month on top of my monthly mortgage payment. So the mortgage is fully paid for and then some. And according to current Zillow estimates, my home is currently worth more than 15% what I initially bought it for in less than 3 years' time. You don't have to be rich or have a perfect credit score to be able to buy a home. There are programs out there that allow people with less than average credit scores to secure a mortgage, so definitely talk to a lender about your options and see what you may qualify for. Don't let your limiting beliefs keep you from achieving a dream you may have. If you're going to pay to live somewhere, you might as well keep some of that money through building up equity and through price appreciation in the property. So guys, I hope you enjoyed that video and that you may have learned a new thing or two from it. This is just one of the many topics I go deeper into in my book, so if you haven't yet checked it out and are interested, please do. It's available on Amazon as an ebook, a paperback, and audiobook, so whichever format you prefer. Let me know in the comments below what questions you have about homeownership, what new thing you learned in this video, as well as any other topics you want me to cover. And as always, subscribe and hit that notification bell as well as hit that thumbs up button or leave a review wherever you're listening so that more people can learn this useful information organically and so that I know you got some value out of this video. Thanks so much and go get them.